CLM, the premium works in your favor. This article was written by the Gaming Dividend. Summary: Cornerstone Strategic Value Fund, CLM, offers a high dividend yield of over 15% by holding traditional equities, unlike other high-yielding funds relying on option strategies. CLM's dividend reinvestment at NA provides an instant capital gain, making it attractive despite a high premium to NAV. The fund's heavy reliance on net realized gains and technology sector exposure poses risks, particularly in down markets. Upgrading CLM to a buy due to the current premium, dividend reinvestment benefits, and alignment with potential market catalysts for growth. Overview: Cornerstone Strategic Value Fund, CLM, operates as a unique closed-end fund that has the main goal of providing a high level of income for shareholders. I've covered a ton of these high-yielding funds recently, and a lot of these have the vulnerability of being linked to a single entity, which introduces a higher level of risk that many investors may not be comfortable with. For instance, I recently covered a plethora of different YieldMax funds, with the most recent being YieldMax Universe Fund of Option Income ETFs, WMAX. Although WMAX has ETF in its description, the fund is a bit more convoluted with the inclusion of an option strategy and doesn't actually hold any underlying equities within a previously covered CLM back in May, and the total return has outpaced the S&P 500 since then. I previously issued a hold rating due to the higher premium at the time, but I wanted to revisit that assessment. It typically ease off the gas and stop accumulating closed-end funds that trade at a high premium to NAV. But CLM is an exception because of a strategy that rewards shareholders when the price is in the premium territory. CLM's strategy has the inclusion of a dividend reinvestment benefit that allows a sonic opportunity to capture an instant capital gain on a monthly basis. What I like about CLM is that the fund managers have found a way to maintain a high dividend yield of over 15% while still holding actual equities within. Despite offering a much lower yield than WMAX's current dividend yield near 40%, CLM is proof that a high dividend yield isn't all there is to a fund's success. We can see that CLM outperforms a high-yielding alternative like WMAX by a sizable margin on a year-to-date basis. So let's first start by quickly reviewing CLM's fund strategy and investment methodology. Fund strategy. Unlike other high-yielding closed-end funds, CLM doesn't rely on option strategies to boost the total income that is generated. In addition, CLM opts to hold traditional equities within, rather than including a ton of different income-focused assets. This separates CLM from the batch of other high-yielding funds because the selection of holdings essentially represent an index that can serve as a solid anchor to your portfolio. In comparison, a fund like WMAX operates in a synthetic nature by implementing different option strategies to simulate the daily price movement of the stocks that the fund aims to mirror. On the other hand, CLM's daily price movements can usually align with the S&P 500. This is due to the holdings breakdown that remains quite similar to the index. For instance, we can see that 30.68% of the assets lie within the technology sector. This is followed by exposure to financials and healthcare, accounting for 12.48% and 11.28% respectively. With an investment in CLM, you gain exposure to the best large-cap companies in the world, such as Apple, AAPL, which accounts for 7.29% of assets. This is followed by Microsoft, MSFT, making up 6.24%, and NVIDIA, NVA, accounting for 4.98%. Since the majority of CLM is comprised of technology exposure, it's safe to assume that this sector will have the heaviest impact of the success of the fund going forward. However, I am disappointed that CLM has failed to deliver a similar amount of growth as a technology-heavy fund like Invesco QQQ Trust, QQQ. We can see that CLM is down over 57%, while QQQ has risen by over 410% over the last decade. So how does CLM actually generate the needed income to fuel the high distributions if the price continues to slide downward over time? CLM essentially pays out all of the upside in the form of a distribution, as the fund relies heavily on the captured gains from positions held within internal performance and outlook. In an effort to help visualize CLM's internal workings, I want to reference the most recent semi-annual report. Since the fund doesn't implement any sort of option strategies that can help generate additional income, CLM relies heavily on the combination of net investment income and net realized gains. Since CLM has a majority exposure to technology, net investment income levels aren't typically high. Net investment income includes the interest and dividends that CLM receives from its underlying equities. Unfortunately, tech companies aren't typically known for their large dividend yields or consistent dividend raises, since these businesses generally choose to reinvest their earnings back into their business instead. For instance, we can see that net investment income landed at a modest zero point zero 0.05 cents per share by the midpoint of 2024, which isn't even close to being enough to support the total distributions amounting to 65 cents per share by the end of June 2024. Therefore, CLM is almost entirely reliant on net realized gains to fund the distribution amount. We can see that net realized gains amounted to 94 cents per share for this semi-annual report, and we can see how realized gains carried the weight of the responsibility when looking back at prior years. For instance, we can see that a lot of the fund's success has revolved around the ability to grow NAV over time. This is one of the first problems I have with the resilience of CLM decaying ag during down markets. We can see that the NAV shrunk from $10.23 per share at the start of 2022 and ended that same year at a NAV of $6.48 per share. 2022 saw markets continually decline through the year, and CLM was negatively impacted a lot more heavily than a traditional index like the SPDR S&P 500 ETF, SPY. CLM fell by almost 50% over the course of 2022, while SPY retracted by about 20% in comparison. Indexes like the S&P 500, Dow Jones, and the Nasdaq all continue to hover near their all-time high levels. Therefore, it may be a bit of a scary time to initiate a position in a fund like CLM if the market momentum shifts to a negative sentiment. However, I believe that we have a ton of catalysts to look forward to in the near future that can drive the market higher. The Fed can continue to cut interest rates, which will serve as a catalyst to debt-heavy industries as it becomes more cost-efficient to pursue growth with debt capital. We also have inflationary data that has generally cooled throughout the year, showing a sizable decrease from the prior year's data. This could help boost consumer spending levels if inflation levels continue to trend downward over the course of 2025, closer to the Fed's 2% target. The market generally has a bullish outlook on assets right now, assisted by the recent rise of Bitcoin, BTC USD, above the $100,000 mark. As market capital gets poured into these assets, it can take markets even higher next year. Lastly, we also have the catalyst of the growing demand around AI innovations to drive valuations higher. Large cap companies that CLMs maintains exposure to continue to pump a ton of capital into the growth around the potential of AI. The data is clearly indicated by a growing amount of job postings seeking candidates with knowledge in the AI space. Research compiled by McKinsey also forecasts that data center demand is estimated to grow at a compound annual growth rate of 27% through 2030. Dividend reinvestment and valuation. Now let's circle back to the main reason why I'm upgrading my rating here with CLM. The dividend was recently increased by 14.6%, up to a monthly amount of 0.1224 per share. However, investors may be scared away by the continuous dropping dividend rate month after month. While I admit that's not the most attractive-looking dividend history over the last decade, this is entirely overshadowed by the strong dividend reinvestment discount that is offered to all shareholders. While I cannot confirm that all brokers currently support this reinvestment benefit, I can confirm that my CLM shares have been getting reinvested back down at the NAV. CLM offers a unique benefit where the distributions you receive can be reinvested back directly at the NAV, rather than the current market price. At the time of this writing, CLM currently trades at $8.69 per share, but the total value of its net assets amount to only $7.32 per share. This means that CLM currently trades at a premium to NAV of 18.72%. Therefore, all dividends received are automatically reinvested at the NAV and grants the shareholder an instantaneous capital gain of 18.72%. This is one of the rare exceptions where the premium is working in your favor. CLM offers a comprehensive explanation of the process that I'd recommend reading. So in a scenario where the future is strong for tech and CLM is able to effectively capital, Investors have the possibility of capturing both capital gains, a strong dividend yield, and automatic distributions reinvested at the NAV. Additionally, the latest Section 19A notice reveals that most of the distribution is being funded by return of capital. The latest distribution from November shows that more than half of the total amount is being funded by return of capita, which can contribute to a decaying NAV, but also make the holding more flexible, as it can be utilized outside of tax-advantaged accounts with a lower tax burden. To help visualize how much of an income compounder CLM can be, I want to run a back test of a position, starting with a sizable $50,000 investment at the start of 2015. This assumes that all dividends were reinvested month to month, and you added an additional $500 worth of capital every single month to your position. At the end of year one, your position in CLM would have generated you an annual dividend income of $12,184. Fast forwarding to 2024 year to date, you would now be collecting over $20,000 annually. The best part is that this doesn't even include the distributions being reinvested down at the NAV during periods when CLM traded at a massive premium to NAV. The fact that distributions are reinvested down at the NAV ultimately helps offset the price decreases that have been experienced over time. This concept helps reduce an investor's cost basis since timeshares are reinvested, combined with the strategic use of return of capital, which also contributes to a lower cost basis. Risk profile, as previously mentioned, CLM is reliant on the underlying equities to appreciate in value so that realized gains can fuel the distribution and the fund can avoid a large level of NAV decay. Goldman Sachs recently released a forecast that estimated the S&P 500's average annual return to be as low as 3% over the next decade. The short summary to this outlook is driven by the estimation that the large-cap tech companies will not be able to consistently deliver the double-digit earnings growth they have over the last decade. With many of the catalysts I mentioned early, I don't really see this playing out, but I don't have a crystal ball to reveal the future, so it's important to always consider these sort of risks. As you can imagine, it would be difficult for CLM to capture the needed gains in a market that is moving sideways or down over time. A downward moving market would be even worse, as this can decimate the NAV and cause distribution reductions. Lastly, the last rights offering was completed back in the middle of 2022. Rights offerings are basically a way for the fund to issue more shares and raise additional capital from existing shareholders while the price trades at a high premium to NAV. Since the price has historically dropped rapidly at the announcement of a rights offering, investors could sell out of their positions and cause a shift in momentum. Although the premium doesn't sit as high as it did back in 2022, it's entirely possible for the fund to lower the threshold for a rights offering to take place. Takeaway. In conclusion, I am upgrading my rating on CLM to a buy, as the current premium means that investors are able to reinvest their dividends at a massive discount down at the NAV. As the premium to NAV currently sits higher, so does the potential benefit for investors that choose to take advantage of this current discount benefit. The high distribution yield paid out on a monthly basis can be a great income tool for investors looking to rapidly compound the income produced from their portfolio. I also like that CLM is lit of holdings that make up an index-like experience that follows the daily price movements to the S&P 500. I believe there are a ton of catalysts that can drive the market higher over the next year, and CLM's holdings align it to benefit. This article was written by the Gaming Dividend.